Hello, and welcome to another CAA webinar. We appreciate you joining us today, wherever you are in the world, whether it's the morning, the afternoon, or the evening for you. I am Rowan Hall, the chair of the CAA's Climate Change Committee, and I'll be your moderator for this session. Today, we'll be looking at the topic, Navigating Disruptive Moments, Challenges of the Reinsurance Market. Before we go into this session, I'd like to say a special thank you to those of you who have previously attended at least one of our webinars, which can be found on our YouTube page or ActiveView, and a special thank you and welcome to those who are joining us for the first time. Today's session is being held in recognition of Earth Day, which is celebrated on April 22. Now, allow me to introduce our speakers for today. Adam is Deputy Head of Analytics and Adam is Head of Analytics and Head of Peril Advisory for Guy Carpenter in Latin America and the Caribbean. He's responsible for the development and delivery of cat-related strategic advisory services to the region, including developing bespoke view of current and future climate risk, reinsurance placement strategies, portfolio management, and parametric solutions. Enrique is Managing Director of Guy Carpenter in Latin America and the Caribbean. He's responsible for assisting with the development and delivery of capital and risk advisory services in the region, including the design and placement of reinsurance and alternative risk transfer strategies. Before I hand over for the start of the presentation, I'd like to inform you that this webinar is being recorded and will be uploaded to the CAA's web pages, YouTube page, and our ActiveView. This may include the Q&A and chat responses. By registering for this webinar and attending the session, you hereby give the CAA permission to use any text, photographs, or video taken during this virtual event. Please place your questions in the Q&A section and they'll be answered at the end of the presentation. I now hand over to Adam.
Thank you, Rowan. Thanks for those kind words. It's great to be here today, and Ricky and I are very much looking forward to the sort of discussion over the next 45, 50 minutes or so. There's a lot to talk about. The reinsurance market globally and in the Caribbean is in a very interesting place at the moment. And we want to talk about, some of the challenges that the market has faced over the last few years. We're going to focus firstly looking at the current challenges, looking at global cat activity and climate change, and some of the macroeconomic and geopolitical factors that are also influencing the current state of the market. We're then going to sort of move on to look at the impact on the traditional reinsurance programs. What do these antecedent conditions mean in terms of the availability of capacity in the market and pricing, the structural considerations because due to the hard market that we've been facing, and some of the consequences for those of you working in insurance companies within the Caribbean, particularly with a focus on rate adequacy and underwriting strategy. And then thirdly, we're going to look at some alternative reinsurance solutions and products that have come to the fore, certainly around structured solutions and parametric products. And then finally, we're going to take a look through the crystal ball a little bit, but what do we expect through the rest of 2024 and certainly into 2025? So we're going to start to think about the current challenges, and this is multifaceted. There's a lot of moving parts, and we'll try to just kind of look at these individually and try and just kind of set the scene for the market that we've seen and some of the events that have happened in recent years that may have got us to this point. We're in insurance, we're in the Caribbean, we face, catastrophes. It's a major, part of the considerations that insurance companies in the Caribbean have to make. Obviously, but if we look back and we just take a step back and look on a global basis, and we try to put in perspective the the landscape that the insurance and reinsurance market has faced over the last decade or so. We can see, looking back at the chart here on the left-hand side, a number of major losses going back over the last decade since 2013. And particularly if we look back at the last sort of 4, 5, 6 years, we see now sort of 5 years where there have been industry losses in excess of $100 billion. So, not all of these are natural perils. The impacts of COVID certainly had an impact in 2020 and 2021, and the Russia-Ukraine conflict certainly since 2022. But there have been a number of major events globally that have contributed to these losses. Even just in the last year, 2023 had $141 billion losses. That includes events such as the wildfires in Hawaii, which were very well publicized. A lot of losses came from severe convective storms in the US. We also had some earthquakes, an earthquake in Turkey, and everyone will probably have seen the scenes of Hurricane Otis in Acapulco in Mexico. And even now, as we look into 2024, we're just getting numbers in, estimates for Q1 for 2024, currently just below 20 billion. And this would include things like the Japanese earthquake in January, again, more sort of severe storms in the US, and a non-natural peril one in the Baltimore Bridge collapse. We know that the Caribbean is obviously especially vulnerable to natural catastrophes, and over the past decade, we've had notable large events in the region. If we look back at 2017, $119 billion losses. Now, part of that came from hurricanes Irma and Maria, and in 2019, Hurricane Dorian in the Bahamas. Just again, to try and put this in perspective, for the Caribbean, if we have a look on the right here, this is a study from the IMF that looked at the impact of natural disasters on the GDP of different regions globally. And as we see there, the Caribbean actually leads the globe in terms of the impact of natural catastrophes on their GDP. We're looking at just below, on average, about 3% per year. But actually, if you look at the extreme of this, we go back to the island Dominica in 2017, Hurricane Maria. That was actually a 250% of GDP event. So the question again, as we kind of put this in perspective, is how much this is driven by climate change. Again, as Rowan mentioned, we're talking on this on Earth Day, and I think in short the answer is maybe partly, but that's not the complete picture. So if we dig into this a little bit more, we've really got to think about what is driving loss escalation. There are many factors in the insurance marketplace that we have to consider. So, loss escalation is not just driven by frequency and severity of nat cat events, and like so we have to look at this from multiple angles. Maybe we just sort of start in the middle here with population growth. Factors such as urbanization, population migration to warmer climates, high value property growth closer to hazards. These are all important when we're thinking about losses because you're increasing the underlying exposure. And I think this graphic in the middle here, which came from our partners at Villanova University, is an interesting sort of way to think about this. So if we take a same event, so this could be a windstorm, this could be a tornado, and we think about the area that an event might impact. As we've seen this sort of urbanization, as we've seen the growth of urban and suburban areas over the last sort of 40, 50 years or so, we see that the same event actually impacts a larger proportion or a larger amount of exposure than would have been there in the past, which therefore amplifies the risk and potential losses. We've also got to consider things like inflation, whether that's social or otherwise. Now, we live in an increasingly interconnected world, and supply chain disruption is an important factor. Monetary policies that are put in place to manage the economy can have an impact, as well as sort of increasing trends in claims litigation. This was particularly evident in Puerto Rico and Florida post Hurricane Maria in 2017. And this has been exacerbated, not through a sort of a widening wealth gap, but also, the COVID-19 in 2020 and the impact that had on things like inflation. And yeah, Enrique is going to talk about these in much more detail as we go through the presentation. When it comes to climate change and thinking about loss escalation, what else could be driving losses? Well, most obviously is the physical risk, which is obviously the direct damage to insured assets by weather and climatic events, which can obviously lead to adverse losses and an increase in volatility around those losses. But we've also got to think about different types of physical risk as well. There are there's what you call acute physical risk, and these are what are more sort of sudden and severe. So this may be, a hurricane, but also there are more sort of chronic risks. So these are risks that change gradually over time, and particularly in the Caribbean, sea level rise, has the potential to be, a factor going forward. But we've also got to be conscious of other types of risks, such as transition risk. This can occur when moving to a low carbon economy, including policy, technology, and market risks, and also, the influence of investment returns and asset values on and underwriting strategies. And finally, liability risk, which is the risk of being sued for one's role in creating or failing to adapt to climate change. So we've got all these sort of things in play that we have to consider when thinking about, losses and how they've increased over time. I think another challenge that we have is, how do we measure climate change? How do we measure the risk of the future? I think, one thing that the insurance industry has done very well over the past 25 years is it's become very disciplined in managing natural catastrophe risk. Catastrophe models have been a core risk management tool, particularly in the Caribbean. For a long time now, people are very affair with cat models and how they can help manage the risk in the portfolio. But with a changing climate means we can no longer fully rely on the past to inform the future. So we need to, reevaluating risk is very complex. And what we're showing here on the chart on the left is the sort of sliding scale of, how much we think a peril could be, on the y-axis, how much we think the peril may be influenced by a future climate, and on the x-axis, how far, how well we understand the impact on that peril. So, if we've seen sort of extreme cold and extreme heat, we know that those are perils that are going to have, are going to be impacted by climate, and we've got a particularly, a much better, hold on what impact it's going to have. But when we're thinking about the Caribbean, for instance, and you see hurricanes are kind of in there in the middle, there's still a lot of uncertainty. But I think, the reinsurance, the insurance industry and science as a whole is having a much better understanding of the impact these will have going forward. But as I said, it's very complex. We're getting better in understanding the influence, but there are different pathways. There are more tipping points to go forward. And what we're showing here on the right here is sort of comparing a pre-industrial climate versus today's climate. There are different, sort of pathways that we need to think about. So would this mean having, an event of the same magnitude, but they become more frequent, more probable? Or could it be that it's an event has the same probability, but has a higher magnitude? So it's a very sort of complex environment to consider. So we thought we'd now try and put this in perspective of, when we're thinking about the reinsurance market and climate, what actions do markets say? What does the reinsurance market take when it's concerned about climate change? So This is an excerpt. So from the past 4 years, at Guy Carpenter, we've conducted an annual survey of climate sentiment in the reinsurance market. And we've taken a snapshot of this survey in this slide, which summarizes the actions markets are taking when concerned about climate change. So this is a global view, which does vary by region. We're certainly in Europe. We're seeing it's probably the most driven areas of action, and this is partly due to sort of regulatory requirements from the European Union. But interestingly, whilst advocating for price increases and reducing exposure to a region remain the most sort of common actions that we're seeing from the reinsurance market, we do see that there's a reduction over the past 2 years in the percentage of respondents saying that this is their main action that they're taking. But what we are seeing is an increase in reinsurers requiring more climate-related disclosure from primary insurers. So with that short introduction about sort of the climate side of the discussion, I'm going to hand over to Enrique to discuss some of the other factors influencing the current challenges we face in the market. Enrique.
Thank you, Adam, and as always, a tough act to follow. And thank you, Rohan, as well for your kind words at the beginning of the presentation. So building on what Adam has just gone over, let's just take a step back and talk about other issues that are contributing to the hardening of the reinsurance market. And to better understand existing market conditions and have a better perspective about where the market is moving, it is important to reflect about on the circumstances that arguably accelerated the onset of the hardening reinsurance market that we observe today. Again, to put this in context, going back to 2022, perhaps third quarter, fourth quarter, when we were getting ready for the renewals at 1st of January 2023, there was a significant amount of uncertainty about where we were going as a market, if we were going to have or be able to secure the capacity that we needed and have or have no idea about what the terms and conditions for that capacity was going to be. Back then, the conversation or the reasons for the uncertain outlook and most of the conversations that we had with reinsurers around this line ahead circle around these issues. Inflation was at the top of the list. Of course, the increase in interest rates, the geopolitical situation. We have the remnants of the COVID-19 with the supply chain disruptions. Adam already spoken about climate change and cat losses, but also we were talking about what was happening in the capital markets, because some of the capacity that we use to underwrite nowadays is coming straight from the capital markets and not necessarily straight from the reinsurance market. Adam, if you don't mind, next slide. So that was back in 2022. Now, let's walk through what has happened ever since and see, I mean, if some of these issues, how have they evolved? And if some of the concerns that we had at the beginning, a year and a half ago, actually panned out, or if anything else happened differently. So when looking at inflation, for instance, which was at the top of the list of the conversations that we were having for many reasons, but when talking about inflation, now we see that basically in 2022, we were at the top of it. I mean, we're looking at a very complicated levels of inflation, and we were totally uncertain as to whether the monetary policies that the governments were implementing, if they were going to be efficient, and what basically the side effect of what was going to be. Hold on a second, I'm running out of battery for some reason. Here you go. So, but inflation, what has happened in 2023 has eased out and but remains elevated. Here in the US, for instance, the Fed basically intends to restore what they want to keep basically is to have inflation at 2% over time. Currently, the levels are 3.5%. The central bank here in the US has raised interest rates about 11 times, or it did from March 2022 to July 2023. During this period, I mean, most of the conversations that we were having on capacity, we very often were wrestling about why, for instance, from a capacity standpoint, I mean, if interest rates are going up just because of basically governments, they need to fight inflation, would it make any sense for insurance companies or reinsurers to put down capacity that was easier, or I mean, would render the same amount of profit if they were just putting a risk-free security instead of perhaps supporting a Catex sale. Those conversations make the conversation about the capacity and about renewal very difficult. So the effects of basically these interest rates that were rising, not only on the asset side, but also on the liability side of the balance sheets of the insurance companies and reinsurers. For instance, on the asset side, some of the issues that we basically didn't see before and were not constantly monitoring is what was happening on the investment side of the reinsurers. And since most of the investment portfolios of reinsurers are basically in bonds, when we have interest rates going up, what happens to the portfolio of investments is basically, even though we are not selling those investments from a mark-to-market perspective, those investments are coming down. So the asset side of the reinsurance balance sheet is coming down, and that created a significant pressure on how much capacity reinsurers were able to deploy back then. Meaning, if the asset side of the company is coming down, our capital base is coming down, we don't have enough capacity to actually support the risk that in the past we were basically supporting in the past. Now, that was an unrealized loss. I mean, companies were not selling their investments to basically come up with additional capacity, or we didn't have any liquidity issues. So these investments, basically, they roll over, and companies nowadays, I mean, what we're looking at the market from an assets perspective is that most of those investments are now invested at current interest rates. So we don't have that issue of having unrealized market losses. So that has eased out a little bit, but that's from a supply standpoint. So just coming back to it, we had inflation created a significant pressure on the assets, and that created a significant pressure on capital, which was not deployed as we needed it. But counter to that, on the demand side, I mean, just from a property perspective, just from an anecdotal perspective, I mean, if prices were going up because of inflation, well, the reconstruction of my house, let's say, if we have a loss, and it's going to be much higher than it would have been in the past, just because of the prices of the things that are needed to replace anything after an occurrence of let's say, of a hurricane or something like that. It was going to be much more expensive to replace and to reconstruct the house. So demand for insurance companies were basically pushing for insureds to adjusting the limits to inflation. And so the demand for insurance went up. So we had basically, we were going through a moment in time where we have additional demand for capacity at a time where the supply was much less than we needed. Now, let's look at the right side of the chart, and let's kind of take the perspective of the investor. Who is backing up the reinsurance market? Who is putting down the money? Who's actually giving us the capacity to do what we do? And even though this graph just goes back to 2017, actually, if we go back further, we will see the picture may not be prettier than worse than it was, actually. We see a lot of volatility around how we were compensating investors. I mean, it was not, I mean, you see returns on equities from 3.3% to 10%, depending on the year. It's very volatile. And also the cost of capital has been steady, but for the most part, the cost of capital, meaning the amount of money that we needed to compensate for that capacity, for that capital, was for the most part more, I mean, the results that we were rendering were not enough to compensate for that capacity. Now let's look at last year, 2023, which is therefore the first time in a long time we see results closer to 20% on return on equity, which, I mean, we hadn't seen those results in a long time. And of course, I mean, way overcompensate what the cost of capital for that enterprise is. And we obviously anticipate that 19%, 20% is not going to be sustainable, and that those results are going to come down a little bit, not that much. I mean, we're not going to, not at least in the near term, are going to go back to the kind of volatility that we were seeing before. Adam, if you don't mind going to the next one. The previous slide, we talked about inflation, and we talked about if we were able to compensate or not the capital providers for the capital needed for the reinsurance market, I mean, for the demand for insurance capacity. Now let's look at actually what really happened with this capacity. Historically, we see that a year-on-year trend of increasing available capital in the market. Arguably, in some years, the supply basically the supply has been above the required market growth. In 2022, however, we see that in real terms, this capacity significantly is reduced. That was a significant issue. I mean, that most of us had never seen in the past, especially when the demand for capacity was heightened by the uncertainties in the macro environment. Capital levels bounced back in 2023 due to basically a strong underwriting and investment results and the absence of any significant investment losses. As we see on the lighter blue, I mean, we have this traditional capital base on the reinsurance, but also we have an alternative capital source or alternative source of capital, which is basically solutions that are executed in the capital markets. And we see that our reliance on this alternative capital grows every year. And so it is become a very integral part of what we do. We're just keeping track of what's happening in the capital markets on the supply of capacity needed for reinsurance is very important. Now, the catastrophe bond market had a record year 2023. I believe there was like 69 different bonds were brought to the 144A market, totaling more than $50.2 billion in limits placed that year. Now, not all of those limits were placed on cat covers. About 450 million includes a cyber cat bond that was placed back in 2023. But basically, the total outstanding notional amount of property and casualty and cyber catastrophe bonds placed at all time basically reached an all-time high of basically $41.8 billion in capacity available and capital available. Now, I mentioned Rule 144A, and this is an important term to just to make sure that we're talking about, or we understand what we're talking about. Rule 4, cat bonds for the most part are placed under the Rule 144A, which basically is a mechanism for the sale of securities that are privately placed to qualified investment buyers that do not and are not required to have an SEC registration in place. Now, we will see a little bit of a dip on 2024 because there's a heavy schedule of these instruments maturing, and this outstanding of catastrophe bonds basically coming down during the first quarter of this year. However, the feeling, the perception is that even though these maturities are going to be, I mean, there are going to be some new issues that will be replacing the capacity that is maturing that is being retired from the market. Next slide, please, Adam. Now, from a geopolitical consideration, during the past few years, we have been experiencing extraordinary circumstances of political violence and heightened geopolitical instability, way beyond the existing crisis that we have in the Middle East and Ukraine. You know, for instance, closer to home in South America, we have had significant evidence of instability in places we wouldn't have thought about, like Chile, for instance, back in 2022. But also we have seen outbreaks in Peru, Colombia, Ecuador, currently in Haiti, just to name a few. From a practical point of view, there is a significant hesitation, basically consequence of this environment of simultaneous geopolitical reordering, the economic fallout that we have been expecting, even though it hasn't materialized yet, but everybody is basically pointing out that everything that was done to fight inflation is going to come back to haunt us at some point. The resources and the resiliency of the supply chains that were tested back in COVID, there's still uncertainty as to that resiliency is up there or if there's any risk associated with them. On this issue, however, I can only offer you some feedback on the questions that insurance companies are basically raising, more so than answers. because at this moment, I mean, there's no consensus as to, I mean, how insurance companies actually need to deal with geopolitical considerations. And some of the questions that insurance companies are asking, and you can see that in the screen, is do we have enough know-how to understand and manage this sort of risk? Do we have a consistent understanding as to what geopolitical risk is and how do we manage it? Also, from the products that we're already selling, do we have any silent exposure? Meaning, is there any unintended coverage for that would be triggered given a geopolitical occurrence that we're not, I mean, that was not designed within the product, that was not priced in? Those are questions that are being asked from a kind of enterprise risk management perspective. Can we include a geopolitical risk exposure within the kind of economic capital model of the company? Can we model it? So those are more questions than answers. That's what we're basically getting from insurance companies nowadays. So again, this is a very critical area of interest, and one that is has not improved since last year. So we saw inflation has improved. The consequences on capital, basically, it seems to be that we have a good capital that is moving, that is growing, not as much as we wanted to, but at least it's moving forward. But from a geopolitical perspective, there's a significant amount of uncertainty. And again, it's not getting any easier for insurance companies to assess their exposure and how to manage that exposure as well. Adam, if you don't mind. So a year later, I mean, we started the conversation talking about 2022. So if we step into 2024 at the beginning, first quarter, what is that we see? I mean, we see a market that is strengthening. I mean, of course, we have some headwinds we just talked about, I mean, what is the consequence of everything that is happening in Ukraine and Israel with the Middle East crisis, everything that is happening closer to home here in South America and some places in the Caribbean. Adam addressed the whole issue about social inflation, perhaps not affecting us on the property side as so directly, but in the US, for instance, long-tail lines of business liability, we're going through a tough hardening of the market just because of the issue of social inflation. Even though, again, inflation has been somehow, I wouldn't say controlled, but it's a much better level than it was back in 2022. We do still have a lot of questions about the macroeconomic environment. How's it going to be going forward? And of course, issues with climate change and the global catastrophe loss activity, that some of it we understand when we talk about peak perils that are modeled, but in our neck of the woods, perhaps we're exposed to a lot of risks that are not necessarily well understood and well modeled, and we're seeing a lot of frequency or a lot of losses arising from these risks, for which perhaps companies are not pricing them adequately or considering them, very formally within their product offering. But also we have some drivers of confidence. I mean, we do have a market that is returning adequate compensation to the investors. So we expect that what we saw last year is going to be continued in the next couple of years, not at the same level of compensation, but it's going to be enough to compensate for the cost of capital that's going to be charged by investors. We think that the capacity will be there. I mean, not in the same way and in the same scope that we used to have capacity in the past, but the capacity will be there. I mean, that uncertainty about us being able to complete the placement of insurance covers, it definitely is much easier. We see that easier today than a year ago. Reinsurers are able to verify that basically those corrections that were made and that were hastily made last year, I mean, the market is taking note and is being consistent in basically making sure that those corrections are sustainable, that we actually are doing what we're supposed to be doing. which in other words is we're sustaining the discipline and the rigor when it comes to underwriting, and are focused in technical results, and also a modified product offering. So that is basically where we were a year ago, which triggered this heightening of the hard market. And this is how basically it looks today. Now, in the next few slides, we kind of going to talk about perhaps what's going to be happening in the future. But before we do that, thank you, Adam. We're going to talk about, in practical terms, what is the effect that these issues that we have spoken about, I mean, how did they manifest or materialized within the reinsurance process itself, and in the way that the insurance companies structure the reinsurance programs. Next slide, please, Adam. So thus far, we have talked about market dynamics and how some of these underlying issues shaped it. Now let's move now to understand the effect of these dynamics and how they continue to have an effect on how reinsurance programs are structured. Capacity definitely appears not to be an issue now, at least not to the extent it was back in 2022 and 2023. Having said this, however, the way reinsurers are deploying this capacity remains disciplined and away from perils that are not well modeled, priced, and understood. There is definitely consistency in the execution of portfolio management initiatives undertaken in the past. Portfolio management was not necessarily a phrase that we heard a lot about prior to 2022. Nowadays, it's basically an issue, a topic of conversation every time that we're talking about reinsurance. Although we are seeing certain leveling in reinsurance pricing, reinsurers keep pushing for price adequacy based on sound technical validations and their cost of capital. We see, I mean, it's difficult to make a general assertion as to where the pricing is at the moment. We see, I mean, the market, even though we can talk about the reinsurance market globally, every territory has its own dynamics. Some places like Puerto Rico, for instance, that Adam mentioned before, we have been undergoing corrections for the longest, I mean, for longer than 2 years. Actually, what triggered the corrections on that market was Hurricane Maria back in 2017, and we're still seeing some market corrections in that territory. And we're seeing elsewhere in the Caribbean that those market corrections are now being triggered by the circumstances that we spoke about a few minutes ago, and started back in 2021, 2022. Also, going back to the issue of the impact of these issues on the current reinsurance programs, we see consistency in the way reinsurers deploy capacity for peak perils. Reinsurers qualitatively as well continue to push for more restrictive terms and conditions, impacting accumulations and loss frequencies. Frequency is one of those issues that reinsurers are basically shying away from, and they really want to focus on the peak perils that they can model, and not necessarily about the frequency of events that are not well modeled and understood. In other words, they're being much more stricter about or questioning about the definition of loss occurrences within the reinsurance treaties. Next slide, Adam. Interestingly enough, I mean, these market dynamics have prompted insurers to think about reinsurance in a broader way. Questions about how do we buy reinsurance and why do we buy reinsurance the way that we do are asked more frequently. Reinsurance is becoming central and strategic to conversations about growth, financial planning, and the impact and implementation of risk-based solvency regulations. In the past, I mean, most commonly, reinsurance was talked about within the context of compliance. We need to comply with local regulations, and budgets. We need to buy what the regulator tells us to buy and at the cheapest possible level. That was pretty much the conversation. Nowadays is becoming much more broader and more strategic. Some of the structural considerations that are becoming ever more common in reinsurance programs optimizations include financing growth. So if we're running an insurance company and we see that we are overly reliant on reinsurance, questions about, okay, how do we go about growing how do we manage this retained volatility? Because as I mentioned before, reinsurers are not necessarily keen, or there's no appetite for portions of their reinsurance program where there's a lot of uncertainty in terms of frequency. So insurance companies are going to have to retain a little bit more, and that's going to create more volatility in their financial results. And also about the implementation of solvency-based regulatory regimes. In our region, we have several countries that are getting ready for the implementation of Solvency II. So talking about the impact of basically the current reinsurance market on reinsurance program, we just beyond the compliance, we're seeing a lot of more conversation and interest about, okay, how do we grow? How do we manage this volatility, and how do we get ready to make sure that we have enough capital to comply with future solvency regulations? Can we go to the next one, Adam? Thank you. So understanding the importance and dependency that insurance companies have on their insurance programs, we have been observing a more disciplined and focused approach around portfolio management and underwriting, basically more concerned, more focused on technical performance. Higher retained volatility coupled with increased cost of reinsurance have prompted questioning risk appetites, and also analyzing or questioning the way that companies deploy capacity and making sure that they do so on profitable business. This heightened focus on increased profitability has motivated a significant amount of activity and analysis around understanding the portfolio. What I mean with that is, what are those elements of my portfolio that are driving frequency? What are those elements of my portfolio that are driving severity? And making sure that I understand them and that I price for them adequately, or just basically take them out of the portfolio itself. And also adequate pricing, just making sure that the price that I'm charging today is enough to allow for a positive underwriting result, including the increased cost of reinsurance and increased cost of losses as well, just given, as we mentioned before, inflation, not only regular inflation that we know, but also social inflation. Adam, next, please. So before continuing the presentation, in the past, I mean, this reinsurance was not a lot of companies were actively questioned about what is the purpose of reinsurance. They just went ahead and bought it because they needed to comply with the rating agency requirements, with the local regulator, because that was the thing to do. So most of the conversations around the reinsurance program was basically, what is the structure that's going to be the less expensive and that would allow me to have an edge, or a competitive edge. Nowadays, that just because of the circumstances that we have gone through for the last year have actually prompted a lot of different conversations around using reinsurance as a capital management tool. Adam, if you don't mind, let's go to the next slide. And when we talked about reinsurance as a capital management tool, we talk about structured solutions. We mentioned before how the current reinsurance market dynamics have prompted insurers to think about reinsurance in a broader way, specifically when planning around financial reporting, budgeting, capital, and volatility management. Meaning, we're talking to the CFOs now. In the past, we used to talk to the reinsurance buyer. So those conversations are now basically happening at the same time. Within this context, we talked about basically structured solutions, but what are these? I mean, there's no consensus as to what structured solutions are. I mean, some practitioners talk about, they talk about, or they refer to these solutions as products. Personally, I don't think they're products. I mean, it is reinsurance as we know it. The thing is that we're using it for a different purpose. It is basically a way of using reinsurance concepts that we know and are familiar with to solve for perhaps more complex situations involving capital and accounting considerations. Structured solutions are not necessarily, a way of thinking about reinsurance in the way that we thought about it in the past, but it is a different way of basically solving problems normally around capital efficiencies, or more generally to bridge the gaps between the view of risk that a reinsurer has and the view of risk that as a cedent may have as well. It's basically to manage that margin being ceded to reinsurers. And also in this market with prices that are going up, is also a discussion about budget management. Important mentioning here is that when we're trying to bridge that gap between what the expectation of the reinsurance market is versus the expectation of what the ceding company is, these elements, for the most part, they bring these solutions, that they bring about three elements that are common to these transactions. Is that basically, I'm not transferring the risk completely. I am transferring part of that risk for which I don't feel comfortable, retaining. And of course, I mean, there's an element of financing, and that element of financing normally has to do with the diversification over time. And over time, of course, I mean, if things go well and there's no losses, or the loss activity is below what it was expected, then there's a participation in results. Now, these are reinsurance concepts and transactions, and they need to have risk transfer. So it is not about financing, it is about risk transfer. But obviously, I mean, they do have this element of financing that is necessary for just bridging that difference between what the reinsurer think the loss will be versus what the perception that we have about what the losses would be. Next slide. Even though I said that I don't like to speak about reinsurance, structured reinsurance solutions as products, normally in the market, we refer to them as, or we identify to some of the solutions as products. And generally speaking, we divide this in two big areas. Ones that are designed to address things that actually happened in the past. So we speak about retrospective solutions, and obviously those that are designed to address things that will be happening, or that we need to address based on the circumstances that will present in the future. Retrospective solutions, for the most part, what we see happening, and these are transactions that are not very frequent. It is difficult to structure. They're not a lot of liquidity in the market to transfer these sort of risks. But the concepts that we're more familiar with are the best development cover and loss portfolio transfers. And most of the time, especially in this market, when we use these concepts, for the most part, is to address reserve issues. I mean, if reserves are developing worse than we had already anticipated, that's perhaps, let's think about an adverse development cover. Or companies that are saying, well, given these current market circumstances, these liabilities that I have in my books are basically written at a price that I could actually write at a much better condition nowadays. Is there any way that I can release these reserves and I can rewrite this book at a better terms and conditions? And if it is feasible, normally we talk about loss portfolio transfers. When we talk about prospective solutions, for the most part, I mean, we are current existing market conditions, especially in the Caribbean. We see a lot of activity around how, if reinsurers are pushing their capacity up in their catastrophe excess of loss programs and replacing those lower layers, that basically what it's doing is push or making the insurance companies think about retaining more risk, or retaining that first or lower layers in the cat excels. And many companies are not necessarily happy to do so. So one of the solutions is like, okay, instead of, since we're basically obligated to retain, we need to retain that because there's no feasible solution in the reinsurance market. How about if we do a multi-year deal, so we can actually diversify through time the impact of one single event. And we're seeing a lot of those spread loss or multi-year excess of loss programs happening or being considered in the Caribbean nowadays. We also, for capital solutions, if we need to release capital, for instance, if we have an issue with a rating agency that changed their model, or we need to free up capital to comply with certain rules and certain regulations, for the most part, we see companies using structured quota shares. And the structured quota shares, basically, they use the commission structure of the concept to release capital or relieve capital in order for basically grow on the balance sheet of the reinsurer. And also some with less frequency, but we see that as well, is that trying to find efficiencies in placements using the capacity that is being deployed on the top layers of the CAT XLs, on the catastrophe excess of loss programs, where they are capital intensive, more than the expected loss is a capital charge. How can we use that capacity that is being deployed on those parts of the program to help me with the retained risk that I have on my lower elements of my programs? But those are a few examples, and of course, I mean, we can spend a couple of hours basically going over some of this, and more than happy to do so at a later day. Adam, to the parametric risk transfer.
Thanks, Enrique. Yeah, I think likewise, parametric could easily take up a session on its own. But just sort of very briefly, you know, we're just really sort of setting the scenes here and giving a brief overview of what we're seeing in the market. But on the back of the structured solutions, you know, another form of alternative reinsurance solution that we are seeing sort of growing is parametric risk transfer. Parametric's been around for a long time. It's not new, but we are seeing it being deployed more globally, but also in the region, in the Caribbean region. You know, for those of you that are not familiar with parametric solutions, parametric insurance is the type of coverage that pays out a sort of predetermined amount based on the occurrence of a specific event rather than the actual loss that's occurred. So, you know, there's a number of benefits from this. You know, one of those is speed of payments. You know, you don't need to worry about sort of loss adjusters and waiting for policyholders to put in your claims. It's a little bit more, because it's a trigger. It's you know, then you know, payment can be paid in days or weeks after the event has occurred. There's also transparency. I mean, the conditions for the payment are very much detailed in the policy. Reinsurers, the insurance company, the reinsurers know exactly what it is that they're involved in. They know the parameters. You know, example here we're showing here is, you know, a box around Puerto Rico, and all those parameters around wind speed and the area of cover would all be detailed in that policy. And it's also very versatile. It could be, you know, we've seen examples of it being used in many different ways, as a standalone protection, as a way to supplement existing reinsurance structure, to maybe cover deductibles on reinsurance as a sort of a cash benefit product. You know, you really can sort of think out of the box a little bit on this. So, you know, as we said, you know, in the current market, you know, parametric covers are becoming more popular. You know, they have opened up sort of an additional sources of capital in the market, and they do provide another way of managing volatility. So with that said, I'm going to hand over to Enrique to sort of wrap up and think about, you know, what we look forward to in 2025. What are we expecting in the market? Are those challenges going to continue, Enrique?
Yes, thank you, Adam. So generally speaking, there's just thinking ahead. I mean, there's value being created in insurance as long as the companies can increase their net cash flows and reduce their cost of capital. That's just two ways of basically insurance or insurance companies to add value. And we have noted that the kind of net cash flows from reinsurers are healthier and expected to continue to be so in the near term, considering, let's say, from our price and retention increases. We have spoken about positive technical results as risks appear to be adequately compensated and capacity allocated to profitable lines of business, and we expect that continue to be the case. There's also more transparency and focus on key risks being underwritten. Again, we spoke about companies being more, as reinsurance companies being more focused on the risks they can actually model. They understand that they don't want to entertain anything that is unknown to them, that is not being considered within the model. And again, I think that is a condition that will remain at least in the near term. And that was from a price and retention increase perspective. Now, from an investment income perspective, which was an issue back in 2022, as reinvestment rates continue to be significantly higher than a few years back, we don't anticipate, I mean, not at least in the near term, for companies to have realized or unrealized losses on their investment portfolios. That's going to be, again, an issue, a factor that will keep the balance sheets of the reinsurance companies healthy. From a supply and demand perspective, macro uncertainties point to a strong demand for reinsurance capacity. New capacity as well is expected. However, we believe will continue to be deployed in a very disciplined manner. So I don't think in the near term we will be seeing reinsurers perhaps on the pricing relaxing it a little bit, but on the how do they deploy the capacity, I don't think there's going to be they're going to be keeping the discipline very strong and try to shy away from aspects of the risk that they don't like that much. And from a capital perspective, I mean, currently reinsurers enjoy a strong balance sheets and basically they have the ability to grow. Of course, to continue to have this ability to grow, they need to make sure that the compensation to the investor is adequate. And also that, and again, this is a very interesting initiative that not only reinsurers are basically entertaining and executing upon, but also insurance companies as well, is basically considering risk-adjusted performance for capital allocation. The whole impact on my portfolios is a conversation that will continue to happen. So again, I think in the next few months we won't see a significant change in the reinsurance market. I think the disciplined approach to underwriting will remain the same. As capacity continue to roll in, we will see a little bit of a pressure on rates, as we are already seeing in the Caribbean. I mean, some programs are renewing flat. Some programs actually are getting a little bit of a discount. For the most part, there are still corrections, I mean, depending on the jurisdiction, on the country that we're dealing with. But the outlook for the market is, I mean, the reinsurance companies are strong and the balance sheet is strong. And in the near term, I don't think there's going to be a significant change to what we're seeing at the moment. I think that'll conclude the presentation from my end.
Okay, thank you very much, David and Enrique. So we just have a few minutes left. So we can probably take just a couple of questions. And I'll just kind of get us started off. As you mentioned, the renewal sentiment, you mentioned that apart from increasing in rates, and some insurers opting not to cover certain regions, you did mention also that they were asking for disclosures from the primary coverers. What kind of disclosures are they requesting, and is this additional information, are they using it to refine or improve the catastrophe modeling results that they have?
Good question. I think feel free to add afterwards, but I think most of the requests from disclosure are certainly coming from the European markets at the moment. There are requirements from a regulatory perspective. I think at the moment it's more of a fact-finding mission, particularly around business that may be associated with oil and gas industry, and requirements to bring that back. I think when it comes to catastrophe models, something that we're very much sort of focused on at the moment is the models do a very good job, but what about sort of future climate environments? And the first stage is to understand, is the model representing the current climate correctly? Is it doing a good job of modeling the current climate? Because you've got to be confident your baseline is correct before you extrapolate out into a future environment. But we're certainly doing things at the moment. If we take Caribbean hurricane, looking at the doing stress tests, looking at the frequency and severity of hurricanes and what impact that could have with different climate change pathways. If sea surface temperatures rise by 2%, 2.5%, 3%, but also helping on the original underwriting side developing, risk hazard maps around flood, hurricane, hail, tornado, multiple perils, and looking at the baseline today, but also the future sort of climate position.
Okay, thank you. Enrique, you want to add anything on that?
Sure. Perhaps just another comment, just to complement what Adam was talking about in terms of the amount of information of the scope of the conversation that reinsurers are insisting in having with the local with insurance companies. It's all about the technical wherewithal that the insurance companies have to underwrite risks that perhaps in the past were just an add-on to main covers. So we had issues with, for instance, in South America, we had issues with SRCC and political violence that perhaps in the past were just an add-on to an insurance product on the property side. And a few years ago, nobody questioned about whether those exposures were adequately and proactively underwritten and properly priced. Nowadays, the conversation has to be very technical. There has to be an expertise developed by the local company around understanding those exposures and pricing them adequately and keeping track of the exposures that they have before a reinsurer is able to or willing to deploy that capacity.
Okay. And one last quick one. Enrique, you mentioned that kind of looking forward, at least in the short term, you're expecting the reinsurance market to stay level even with the increases in capital, as insurers are seeking really just to cover those risks that they are more comfortable with. Do you think that the regional insurance companies here in the Caribbean would benefit from risk experts, say actuaries, being a part of their pricing mechanism? Would that give reinsurers a little more comfort in providing additional capacity or maybe even better rates?
That's a great question, and I'm going to address it in two parts. Actually, the role of the actuary in the past few years has evolved in leaps and bounds. I mean, in the past, and I've been doing this for many years. So a few years ago, the role of the actuary was, for the most part, limited to pricing and reserving. And now we are seeing the evolution, not only in the Caribbean, but pretty much everywhere in the region and elsewhere, of becoming a much more strategic partner and decision maker when it comes to capital management and everything that has to do with enterprise risk management. So absolutely, for reinsurers, they see that if a company is well organized in terms of understanding their risk, they have a good ERM program in place, and they have somebody that is actually responsible for understanding what is the tolerance for risk that the company has, that they have a risk appetite statement, and that their reinsurance programs are consistent with the way that the company is set out to take risk. That makes the whole conversation easier. So yes, reinsurers that see seeding companies or insurance companies being much more formal about risk management, they tend to have an easier conversation. They tend to be more, let's say, prone to deploy capacity and work with these companies much more.
Okay. And final words, Adam?
No, I just thanks very much for Rowan for inviting us to talk and being able to present in front of the Actuarial Association in the Caribbean.
Thank you.
Okay, and thank you both for being with us, and thanks everyone who came for this webinar. You can look out for it on our YouTube page and ActiveView, and also remember to find us on LinkedIn and stay connected with us. Thanks again and enjoy the rest of your day.
Yeah.
Thank you.